Hello again, David here with BeInCrypto. Today, we're going to get into a topic that's been taking the decentralized finance world by storm, and that's yield farming. Yield farming has been making headlines lately, and it seems to be on everybody's radar, but what is it exactly? Well, in this video we'll explore how does yield farming work? We'll walk you through a practical example. Then we'll discuss some of the risks involved. And at the end, we'll explain the easiest and safest way to get started today using the Yield app. By the end of this video, you should understand the basics of why this is such a hot topic right now, and have some idea if you'd like to start using these techniques yourself. So with that, let's jump right into the world of yield farming. First of all, if you haven't already, go and check out our previous videos on Bitcoin, DeFi, and Ethereum 2.0, as they definitely help to lay the foundation for what we'll be covering here. Let's quickly touch on what's important though. In our Decentralized Finance video, we explained how DeFi allows individual users to do the same types of things that are available in the legacy finance system, only in a decentralized manner, which is not controlled by any business or authority. This is part of what makes DeFi so powerful, and yield farming has evolved thanks to this freedom. Take for example liquidity pools. These pools allow anyone to stake their own assets into them in order to earn a passive income through interest. The interest is generated from the trading fees imposed upon users who tap into these pools to make exchanges, and they're distributed to every liquidity provider based on what percentage of the total pool they provide. This is all pretty straightforward, and again, there's comparable services available in the legacy financial system. However, there's more. You see, there's a couple things about DeFi that set up the space for new levels of returns manipulation, so let's explore that now. For one thing, many of these pools don't only give liquidity providers a cut of the trading fees, they also offer additional incentive in the form of tokens. These are usually governance tokens for the decentralized protocol that runs the pool. This means that holders of these tokens get a voting stake in any future changes to the network. So let's just walk through an example. Know that there's a variety of possibilities, but we're going to explore a generic, simple one to give you the general idea. Let's say you have 200 USDC, a stablecoin, and you want to enter it into a specific liquidity pool, which will begin earning you a slow but passive interest, usually anywhere from a fraction of a percent up to several percentage points of return per year. You're then, in addition, rewarded 200 of the previously mentioned governance tokens, which should have some intrinsic value because they represent the right to vote on changes and updates to the network. At this point, maybe you're saying, great, so I have a stake in the voting. What does this have to do with making money? Well, here's where things get interesting and where earning yield turns into yield farming. See, those 200 governance tokens are effectively yours, though bear in mind you will still need them to get your initial deposit back. But for now, they can themselves be staked or traded. This means you have multiple options. For one, you could stake them into another liquidity pool, which would further multiply your returns. Also, because many of these platforms support a wide variety of tokens, you can sometimes even trade your reward tokens for more of the original asset you were using, which you can now reinvest into the original liquidity pool, earning you even more of the reward tokens, and often this can be done multiple times. The net effect of this is that you'll get a notably higher return than simply earning a single yield would. By mixing and matching different decentralized loan platforms, liquidity pools, and trading platforms based upon rates of return and offered rewards, users can maximize their profits many times higher than they otherwise could have. This alone began to draw the attention of crypto investors, but on top of everything I just mentioned, the frequent trading of these rewards tokens inevitably drives up their value, meaning that the technique I just described can begin to offer exponentially greater profits. Now I know what I just laid out might sound a little complicated, or it might sound like free money. Well, it's a bit of both, and because of this, it's absolutely fraught with risks. Like anything in this world, the potential for high rewards always comes along with a comparable chance of you losing money. So let's take a look at the reasons you may not want to get involved just yet. First up is smart contract failure. Because the entire field of DeFi is young and still growing, problems can occur. As we've discussed before in other videos, there's generally always a chance that a smart contract could either fail or have some exploitable imperfection that could lead to a loss of funds. To this end, you're always taking on some amount of risk, so it doesn't hurt to do some research to see if a project's code has been audited by an independent, respected company. If so, it's at least a good step in the right direction, and if not, then definitely proceed with caution. It also doesn't hurt to wait a bit and watch the track record of the network and the commentary by the community. Are people actually using this platform, and if so, what are they saying? Is anyone reporting bugs or losses of funds? Watching a project operate in the wild can give valuable information to users who can't audit the code themselves. Next up, there's the risk of impermanent loss. When a liquidity provider enters into a pool on Uniswap, for example, they provide an even amount of two separate assets, let's say ETH and USDC. Uniswap and similar platforms require a 50-50 distribution of these assets in terms of their value. So, if you wanted to deposit, say, $1,000 total into the pool, you would have to put up $500 worth of USDC, which is a stablecoin, so 500, and $500 worth of ETH, so the exact amount would depend on the price at the time. Now, impermanent loss comes in when the price of Ethereum begins to rise. You may think that sounds like it should be a good thing, and it basically is. But remember, your contribution to the pool is always going to be in a 50-50 ratio, meaning that as the price of Ethereum rises, your pool will be selling off Ethereum in exchange for USDC. So, as Ethereum gets more valuable, you're actually holding less and less of it and accumulating more of a stablecoin. The same thing, of course, happens even if neither coin is a stablecoin, but the stablecoin example is easier to visualize. The point is you're always selling off the better performing coin in exchange for the lesser performing one. This is called impermanent loss because it only becomes realized if you should take your money out of the pool. If you stay in and the prices return to the same ratio as when you entered, impermanent losses will be erased. You may ask, why would anyone provide to liquidity pools if this is such a common occurrence? After all, crypto's volatile and always changing, so impermanent losses must be common. The best explanation here is the previously mentioned rewards via fees and governance tokens. Due to the potentially high yields on those rewards, users will often accept a certain degree of impermanent loss in these pools so long as the returns from farming reward tokens keeps them profitable. One last risk that we should cover here is what is being referred to as rug pulling. This practice involves creating a brand new token and providing liquidity for it on a platform like Uniswap. So, you create something called, say, Scam Token, and you deposit 100,000 worth of this coin, which you made yourself, along with an equal amount of Ethereum. This starts attracting others to the pool, but as the creator, you can mint new coins whenever you want. So, you wait until a sufficient amount of interest and money has begun to flow in, and then you privately mint a whole bunch of new scam tokens at basically no cost to yourself, and start to sell them into the market. You're now collecting Ethereum in exchange for tokens that you're making for free. At some point, others will notice and begin to sell out as well, but at this point, the price will really begin to deflate. In the end, those who never jump ship will be left with the majority of these tokens that have no real value, but now there's nobody to buy them. The original scammers, however, have plausibly turned their $100,000 investment into millions. This is unfortunately going on right now in the DeFi space, and can happen shockingly quickly. New coins can be introduced, balloon, and crash in just a matter of days, and it seems like lately there's no shortage of these stories going around. Basically, I can't emphasize this enough, be patient and do your homework with these projects. If something is new and unaudited, it is extremely risky to throw your money into it, and practices like rug pulling are exactly why. There's one more side effect of yield farming that we want to mention quickly. While more money than ever is pouring into the DeFi space, this has also caused the gas prices on the Ethereum network to skyrocket. Gas is the term for transaction fees on Ethereum, and they rise under heavier usage. This of course slows down the average transaction time, increases the cost of interacting with dApps, and generally degrades performance across the network. As Ethereum scales, issues like this should become less dramatic, but for the time being, the rise of yield farming and DeFi in general has put a premium on transaction fees. Now, for users who like the sound of putting their money to work but are concerned about some of the risks and complications I've outlined, they might want to take a look at the Yield App platform. Recently launched, Yield App lets you deposit funds using any regular bank account and begin earning yield on them with just one click. This is possible because the team behind the app is managing all of the more complex steps for you in the background. They're continually finding a diverse range of both high-yield pools, low-risk pools, and other DeFi offerings, with each investment being rebalanced daily. This means they can offer anywhere from 12 to 20% yearly returns on deposits with minimal effort or risk for their users. Right now, the platform hosts USDT, USDC, and the project's own yield tokens, but Bitcoin and Ethereum support are just around the corner, with an even wider range of assets being planned for later this year. Well, that's probably enough info for you to wrap your head around for one video, and of course, there's still a ton of details to learn. If you'd like to keep going, we've added some helpful links down in the description to aid you on your journey. Also, you'll want to stay up to date on the latest developments in cryptocurrency, DeFi, and yield farming, so make sure to come on over to BeInCrypto.com for breaking news, as well as deeper explorations on all of these topics. Want to go even further? Then don't hesitate to check out our other reviews, educational videos, and interviews here on YouTube. Of course, if trading is your thing, then come and join our BeInCrypto trading community on Telegram, where you'll get access to the latest technical analysis performed by our top traders. As always, thanks so much for watching, and we'll see you on here again real soon.